this week's outlook. I'll start off with the calendar this week, as it's very simple, and then we'll go into the actual market summary and then individual currencies. It's going to be a very short outlook this week, just because it's all narrative driven, with the narrative either being de-escalation or escalation. So yeah, with the calendar this week, we've literally only got these three that I'm keeping an eye on. On Tuesday, we have PPI from the US, which is forecasted to jump by 50 basis points to 1.2%, or 5 basis points, sorry, to 1.2%. We then have Thursday, which is we get GDP from the UK, and then also labour market data from Australia, which is going to be key for yields. However, we know that this is a sentiment-driven market, and our eyes are mainly going to be on what are equities doing, what is oil doing, and what is the dollar doing. So yeah, that's kind of going to be our focus this week. So yeah, going into the actual individual market, into the market summary more I should say, essentially markets are clearly preferring the de-escalation narrative. Since April 7th, equities have rebounded nicely. The VIX is back at pre-war levels, below 20. I believe it's at like 19.75 or something like that. Oils retraced around 15%. The dollar's closed below the 99 handle for the first time since the war kicked off, which is leading to gold rebounding. And then obviously we're seeing yields start to cool off a tiny bit. So all this indicates to me that markets are preferring the de-escalation narrative for now. Data-wise this week, as mentioned, we've got PPI, UK GDP, and then on the Australian labour market data. So it's relatively quiet, to be honest. Three main pieces of data. It's definitely one of the more quieter weeks. Market open will be key. So I'm expecting to actually see a slight jolt to the upside in US oil and the dollar, driven from the negotiations this weekend not going too well. But unless we get a crazy gap to the upside in oil, I remain a fan of the de-escalation narrative. And I think it is worth noting that currently, with what we're seeing in the equity markets and oil markets, is equity markets are obviously signalling to us, at least, that we're seeing a lot of risk get priced out of the market. So we're seeing equities rally off the back of the de-escalation narrative, off the back of negotiations, off the back of all this stuff. However, why has oil not moved at a similar rate? And that is because, I think personally, because the markets are starting to price in de-escalation. Right, the markets are pricing in a good bit of risk on. However, the baseline for oil prices is going to continue to be higher than the previously. So let's say oil previously was hovering around the $60 mark per barrel. We're now going to be looking at probably around 70 to 80, which is obviously going to then have implications for yields. It's going to have implications for inflation, etc., which is why yields have also not had a massive move, in my opinion. But what has had a massive move, the SPX, NAS. Why are these having big moves? Because it's showing that risk is clearly turning. So yeah, that's essentially where I'm at with what's happening in the Middle East. And I think as long as these negotiations don't go horrendously, it's all just a flow game. So market open is going to be extremely important, because it's going to tell you how the markets have priced in the negotiations over the weekend, which haven't seemed to have gone too well. But they haven't seemed to have gone terrible. So we will see. So yeah, moving on to the actual currencies. We'll start off with the dollar as usual. But yeah, I mean, immediately, as you can see, inflation last week jumped by about 9 basis points. Went from 2.4 to 3.3, which is mental. So pretty simple this week for the US dollar. The markets are running with the de-escalation narrative. We've seen a sharp sell-off in the dollar since April 7th, and until new developments come out indicating escalation, which could be the negotiations, we just need to wait for market open, we should maintain a downwards trajectory on the dollar. Rate differentials and data are taking a back seat whilst this conflict remains in the spotlight, so negotiations in Pakistan seem to be showing signs of the conflict heading in the right direction, but with oh yeah, another good point is actually that the traffic in the Strait of Hormuz has slowly been picking up, albeit they're Chinese ships, but we're starting to seeing a bit more movement in the Strait, which is obviously good for sentiment as well. So yeah, essentially bearish on the dollar. However, this could all change, so keep an eye. I'll leave a comment in the YouTube comment section on this evening after market open, so I'll tell you what I'm thinking, if I maintain the same bias, whatever, because in this market it really can just flip on its head like that. So yeah, bearish on the US dollar. Yeah, institutions, you'll notice that the institutions get super quiet whenever there's political disruption. So like Trump tariffs, the institutions were quite quiet. Obviously the 12-day war, they were quite quiet. Right now they're quite quiet, so we're not seeing a lot of stuff. But yeah, essentially it's all just around that narrative. The pound. So for the pound, we are very much dependent on the cross. So the rebound in sentiment, lower energy prices, and the consensus improvement in GDP this week are all factors which should support the pound. However, it's all dependent on the cross. So personally, I'm going to be wanting to long GU, while long GU, long GCAD, and long GJ. That's what I'm looking at personally. For Europe, similar thesis. Essentially, dependent on the cross. All dependent on the cross. I mean, oil falling supports the pound more than the euro. So if we are thinking about euro pound, we'd be looking for downside personally. But overall pairs, I like shorting euro AUD, I like shorting euro pound, I like shorting euro NZD, but I do like longing EU and ECAD. So that's kind of what I'm looking at there. Exact same thesis around the pound. Falling energy prices is clearly benefiting the euro against specific pairs. Canadian dollar, we are bearish on the Canadian dollar. Pretty simple. As de-escalation continues to be the main driver, we should expect US oil's downside trajectory to support the bearish thesis on the loonie. My main pairs of choice would be EuroCAD, GCAD, AUDCAD, and NZDCAD. So yeah, bearish on the CAD. Australian dollar and New Zealand dollar, we'll get these out together. The rebound in sentiment evident from equities and the VIX should boost high beta currencies like the Aussie and Kiwi. The hawkish tilt from both central banks is also another factor supporting upside in the Antipodean currencies. My preference would be longing AU, NU, AC and NC, obviously that being Australian, the AUD USD, NZD USD, AUD CAD and New Zealand dollar CAD. That's what I'm looking at. Obviously all four of those pairs, are all linked. They're all linked to basically sentiment and the dollar. So I would not be taking all four at once. I'll be taking one of those pairs, the one that gives the cleanest price action. For the yen, I remain a seller of the yen. To be honest, they're just not in the best position. And I mean, even following the April 7th ceasefire announcement, which led to oil retracing 15%, the yen barely had a positive reaction function, which kind of tells you about how much negativity is priced in the yen. And why? Well, domestic issues. They remain clear in Japan, and which is why, in my opinion, we're going to continue to see deep depreciation. For me, I prefer to express my yen bias through longing euro yen, GBP yen, NZD yen, and AUD yen. And then we'll finish off with the Swiss franc. Bullish. The Swiss franc has been following gold's movements over the last few months. However, sentiment is overriding this on specific crosses, so I'd only be considering dollar Swiss downside and CAD Swiss downside for the time being. So yeah, very quick this week, but that's the individual currencies. Now let's go into the technicals. Starting off with the dollar, I'll be looking to get in from around the 99 handle. Something around here looks quite nice. GU, I'll be wanting to get in from the 134, a very nice level. Obviously this is all on the narrative of de-escalation. AU, I like that level there. NU, similar there, of course. EU, there. Dollar Swiss, I think this is a very nice level, but obviously this is just a mapping of the DXY, so we need to be careful off the market open. GCAD, I want it to come down to the 1855, which is going to be interesting. We'll see if we can. But GCAD, yeah. Euro AUD, I think we're in a lovely level. Euro pound similar. I want Euro pound to come a bit higher, which would make sense if we do get a slight jolt to the upside off the open, and then we can get in on the Monday. Euro CAD, I like this level here, just below the 162. AD yen, I want it to fall all the way down here, which is, I don't want to say it's unlikely, but it's definitely a big move to the downside. Obviously similar mapping with NZD yen. CAD Swiss, I like up here. NZD CAD, basically a mapping of NU. Euro yen price action is just a bit horrible. I think this level here could be very nice, but we're very overextended, so I don't think I'd be taking this. And I believe that's it. Yeah, that is everything. And I'll quickly go over oil as well, because market open is going to be key. Well, first of all, if we just look at what Bitcoin has done following the announcement, or following the news that the negotiations didn't go too well, what we can do is, obviously this is all speculative, but we can figure out, alright, off the April 7th announcement, we shot up around 4.3%. Now, we've only fallen around 2% here. So number one, if we do get a reaction, which we are, it's going to be half the size of the April 7th reaction. And we also have to remember, we've not retraced the April 7th reaction. So I think we're going to get a nice pullback to the upside before we can continue going short on the dollar. So I think, fingers crossed, I don't think we're going to, I think, to be honest, what I think is going to happen is, I mean, if we go here, we go there, it's 1.23, yeah, I think we're going to gap up here. So if I was a betting man, I'd probably say we'll get in here for something like this. And then obviously this needs to correlate now with all the other pairs we just went through, but I think something like this would make sense as well. This scenario here is scenario A, which is the most unlikely, which is we get no gap off market open. Oil remains below 100, sitting around 95. Whereas this one here is, right, we get a gap to the upside and we want to catch the dollar downside on the Monday London session. So yeah, that's what I'll be looking for this week. So yeah,